To Kevin's point, or Jeff, one of the two, we just talked about the fact that an Nvidia, say for example, was down about 6% today, but still up 14% on the week, which really just goes to show how good of a day yesterday was. But overall, if you take a look, tech and consumer discretionary, the two worst performing sectors so far this year, and once again today, one of the worst as well.
I mean, definitely. I think, there's a lot going on right now, to say the least. I mean, everyone's quite aware of what's happening, but within the internals, I think, of the technology stack, there's some interesting things happening. Obviously, if you look at this last week, the China-sensitive names, Apple, for instance, still down 6% this week. Nvidia, on the other hand, also, as you mentioned, higher. Broadcom, these are two of the lead architects in the artificial intelligence, semiconductor, and software system space are higher. Then the less sensitive digital-driven stocks like Google and Meta, and even actually, if you look at Amazon, is higher. All those stocks higher by between 1% and 2.5% this week. But I think within the context of all this is semiconductors, because one of the things you have to keep in mind is semiconductors are quite a leading indicator. In fact, if you look at a one-year chart of the SOX, SOXX, you can actually see it peaked back in July of last year. And one of the things I noticed this week is amongst all the volatility, which has been tremendous, I'm profoundly just blown away with what's happening this week. Semiconductors as a whole are relatively flat. They're performing better than consumer staples. And so for what it's worth, I think this market is really trying to carve out a bottom with the most sensitive technology names holding up rather well considering the broader markets and the volatility that we're witnessing.
Following sharp increases in yesterday's trading session, Nvidia's stock is seeing significant sell-offs on Thursday. As of 1 p.m. ET, the share price of the leading artificial intelligence, AI, hardware company was down 7.5%. The Nasdaq Composite was down 5.5%, and the S&P 500 was down 4.5% at the same time in today's trade. Following President Donald Trump's announcement yesterday that imports from all countries except China will be subject to a 10% import tax rate, and that his administration's harsher retaliatory tariffs would be deferred for 90 days, the stock market enjoyed almost unparalleled single-day gains. However, Trump also declared that the 104% duty on Chinese goods would be raised to 125%. Yesterday, investors focused on the halting of reciprocal tariffs for all other nations. But today, the market is responding to the possible consequences of the growing trade spat between the United States and China. Nvidia's stock is currently down 29% from its peak and 21% year-to-date following Thursday's sell-off. Given the quickly changing macroeconomic environment, Nvidia's share price will continue to see significant fluctuations. Investor attention has naturally switched to the big picture, despite the company's continued unquestionable leadership in powerful graphics processing units, GPUs, and other AI gear. And since there is still a lot of uncertainty ahead, it seems reasonable to be a little cautious. I believe that purchasing Nvidia stock at the current price can still result in significant profits for long-term investors. However, as part of a dollar-cost averaging approach, I would advise viewing pullbacks as investing opportunities rather than jumping all in at once. By traditional measures, the share price has been driven to a low point, but there is potential for more sell-offs due to macroeconomic and geopolitical risk factors. So, what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Investor and shareholder letter today and responding to some of the, current volatility that his consumers see, but then push us forward as to what your view is on AI and if AWS still sees insatiable demand. Many have been trying to work out whether the AI bubble that has so inflated this market is anyway intact. Is it?
Oh, we think so. I mean, everybody looks at the market and says, oh, well, the stocks are way down, so AI must be falling apart. They're just high beta stocks. They have two betas, so they're twice as volatile as the market. So the market's going down. What do you sell? You sell the volatile stuff. You sell the investment banks. You sell tech stocks. This doesn't mean the AI market has changed. And that's one reason, though, because we do believe there will be continued AI spending, and Jassy's comments certainly validate that. Really, it's investment and not consumption that drives recessions. So AI spending is offsetting a slow housing market. And another thing that people haven't focused on, rates have come down 50 basis points.
Yeah.
It was disconcerting yesterday when they were skyrocketing, by the way. I thought the market might crash then. But that is helpful. It's not going to get the housing market to boom, but stabilize. So if you look at investment, you can predict recessions pretty well. Stabilizing housing, strong tech spending, that adds up to slow growth, say, in that 1% to 2% range.
After a spectacular run the day before, semiconductor stocks fell sharply on Thursday morning, with Nvidia reporting significant losses and Broadcom leading the drop. Near lunchtime, Broadcom fell about 7%, and Nvidia fell more than 5%. The day before, both equities had jumped more than 10% after President Trump put a 90-day hold on most tariffs while trade deal talks took place. According to a different story, the White House changed its mind on banning Nvidia's H20 GPUs for China in the midst of this unrest. Other significant chip makers, however, were not exempt. Texas Instruments, AMD, Intel, and Marvell all had decreases of around 8.5%, 8%, 7%, and 12%, respectively. As sales increased, Qualcomm, Micron Technology, and Analog Devices also saw declines of at least 6%. In line with the general decline, the Philadelphia Semiconductor Index, SOX, dropped by about 8.5%. The global electronics supply chain may be further disrupted by Trump's tariffs, according to analysts, and companies may decide to postpone earnings projections for the forthcoming season. In order to relieve pressure on suppliers such as Samsung Electronics and SK Hynix, the United States has abandoned its plans to restrict the shipment of Nvidia's H20 artificial intelligence chip to China. The proposed restriction was initially put up during the administration of former President Donald Trump, with the intention of limiting China's access to powerful AI chips that use state-of-the-art high-bandwidth memory. As Nvidia's H20 depends on HBM3 and HBM3E, which are primarily provided by Samsung and SK Hynix, it would have had an impact. Chinese digital behemoths Alibaba, Tencent, and ByteDance hurried to order over $16 billion worth of H20 chips earlier this year out of fear of supply shortages. According to reports, Nvidia CEO Jensen Huang met with Trump at Mar-a-Lago and made an investment pitch in AI infrastructure located in the United States. Although no specifics have been made public, it is thought that the meeting had an impact on the change in policy. Samsung is currently seeking to requalify as a supplier after pausing HBM shipments because of uncertainties. It is anticipated that SK Hynix will also start shipping again. As long as HBM is utilized in chips made by American companies like Nvidia and AMD, these businesses are permitted to export it to China. Chipmakers stuck between rising AI demand and geopolitical risk now have some breathing room thanks to the move. However, businesses are nonetheless wary of potential regulatory changes because of the ongoing high-tech tensions between the US and China. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
All right, so we had Brad Gerstner from Altimeter Capital on our air yesterday. He said the pause, it gave tech CEOs, it gave tech companies a framework that will let them move forward and kind of ease some of the questions about what's going to happen next and ease a lot of the uncertainty. Do you agree with that take?
I mean, look, I think there's a framework, but the reality is that there's mass uncertainty. And I think you could still have 10 to 15% CapEx large purchases that ultimately significantly get downsized or at least get paused. And I think that's the issue here. I think tech is going to be very volatile going into earnings season. I think a lot of these companies either don't give guidance or give very general guidance. And I think that's just the reality of what's happened. You've set a storm in motion. We came off the cliff, no doubt, very positive for big tech. But we're still, I think, only a quarter way through this.
Well, I mean, absolutely. A lot of these stocks are still well off their 52-week highs. What do you make of the rally yesterday and the pullback today? Nothing really fundamentally changed from yesterday. Why do you think we're seeing such a sharp pullback today? We're looking at Nvidia shares down more than 3.5%, Microsoft pulling back about 1.5%. We're going to get to your Microsoft call in just a minute.
It's like being in a storm, and then you come out in a hurricane or a tornado, and you come out, what's the damage? The damage is real. I mean, uncertainty. I mean, we talk to so many out there in the field, in the US, in Europe, across Asia. And I think the reality is like this has created a lot of uncertainty for the tech world. But China is the hearts and lungs of the tech world. And those tariffs are going to continue to increase. And I think that's the worry here, is that you're playing with a third rail issue when it comes to China. And that's what, from Apple to Nvidia and the rest of tech.
All right, let's get to your Microsoft call. You lowered Microsoft's price target from 550 down to 475. Part of your thesis is that tech spending, CapEx spending related to data centers and everything is pulled back 10 to 15%, and you're saying that's conservative. Why? I mean, the tariffs, if we're being fair, and Brad Gerstner pointed this out, they've only been in place for about a week, maybe 10 days, and we had some insight that they were going to come. What has fundamentally changed so much that you think spending is going to pull back 10 to 15%?
CapEx plans are paused. I mean, from a large
But why don't they just restart? Isn't that the whole thing?
Because ultimately, it's like once you start that snowball, you can't just stop it. And when you look at it, it's still paused, but then it all comes down to China. China is the epicenter. How many companies are exposed to China? On the tech side, it was from when you think about shipping, what's coming in, parts. If a CIO ordered something, it's $100,000. Is now they paying another 100? Is it going to be double? So I think that's part of the issue. When it comes to Microsoft, and you'll see this with Google, you'll see with Amazon in terms of hyperscaler spending, I think it's paused a lot of what we're seeing.
Well, let me push back on you. You're saying it's paused, and you're saying it's primarily because of the China tariffs that, again, have jumped up to 125% right now. But if there's a deal made with China, the president seems to be very confident that he can make a deal. Does that change the whole outlook? Does that go back to boosting CapEx spending? And then how do the sector tariffs and the metals tariffs, how do those impact that?
Yeah, it's a great question. Well, first off, I think at this point, Street's going to look at June quarter is basically a mulligan. In other words, June quarter is going to be very, very soft. And I think investors will look to any sort of sign of a China deal and a de-escalation. To your point, the reason we haven't downgraded one tech stock, we've lowered target, is because, in my view, it's going to be the COVID playbook. You throw out 2-3 quarters, you look at 26 earnings, and you look at a worst best case, and that's the way that you pick the valuation of the winners.
Let me ask you something that I'm sure you're at least beginning to think about. So a lot of these big-time tech CEOs, they were at the inauguration. They've been going to meet with the president, and the president's been very proud to say that they're going to increase their spending, like Apple increasing its spending here in the U.S. If they pull back, does that raise the risk of them drawing like the ire of the president and maybe an administration that's not so friendly?
Of course, because the reality is all those projects that you're talking about in terms of Stargate and everything else and some of the app projects, how are you building that? Where is it coming from in terms of the products? I mean, it comes down, China is the epicenter. So it comes down, the unintended consequences here are key. And look, big tech, they're caught in the middle. And I think they are still trying to get their grasp. Apple's not flying 4 airplanes of iPhones if they felt that they were ahead of the game. It's a game of high-stakes poker, tech caught in the middle.
All right. We'll look at Nvidia's standing in comparison to other stocks that Jim Cramer discusses. Jim Cramer launched the Mad Money Show on Monday, April 7th, with a message of composure among upheaval. After 9 straight lower starts and another day of tumultuous stock market activity, Cramer made it clear that the pain is genuine. Do we have a systemic issue, which means that our institutions have real flaws that are difficult to fix? He acknowledged that a recession would occur, but he denied that we were about to see yet another global financial catastrophe. Since our institutions are robust and we don't think the entire economic system is in danger, my partner David Faber and I talked about this very topic this morning and decided that we needed to rule out the possibility of a financial crisis. We don't think that big banks will fail, but for heaven's sake, we don't like this condition. The president's foolish policies are probably going to send us into a recession, but we'll get out of it eventually. It will not be the second global financial crisis. Cramer maintained that leadership choices were the primary driver of the market's downturn rather than inflation, interest rates, or even negative profitability. He referred to the decline as man-made, stressing that if the administration took a different approach, it could be undone as quickly as it started. The decline's estimated cause is then revealed to be man-made. We have a material president who can declare Trump and roll back these tariffs with a stroke of inaudible, but where would we be if Wall Street were afraid by them? Nothing would have been purchased by us. Additionally, the White House will eventually be unable to stand a stock market meltdown. Cramer was more worried about the tariffs' underlying purpose. He believed that the administration's goal went beyond simply rebalancing trade, but to undo decades of globalization by compelling businesses to bring their production back to the United States, even if doing so meant causing long-term economic hardship. The goal is to get American manufacturers to return to the United States, not only to exert pressure on China. Apart from Vietnam, this is the reason for the high tariff in Vietnam. Not only are those two agenda items crucial, but they also indicate that no negotiation is feasible because doing so will deter businesses from returning. Trump wants to change history, and while tariffs may increase some revenue or encourage home manufacture, they cannot change the past. He wants to finish the task as soon as possible, yet it's a difficult and foolish task. Kramer concluded by outlining the difficult list of requirements for the success of the current approach. For Trump to successfully restructure the world economy, restore home manufacturing, and bring China to its knees, a number of conditions must be met. First, the Fed cannot lower interest rates to save us if the high tariffs lead to a jump in inflation. Second, he needs to swiftly negotiate new trade agreements before the members of Congress who are meant to be in charge of tariffs wake up. Republicans in Congress are more likely to disregard the president's agenda if the market declines. Third, he must accomplish this without significantly increasing the unemployment rate. If he wins all three, I believe he will find a pretext to declare victory and pull back the tariffs rather than pressing his bet, which explains why today's market meltdown was avoided. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
All right, now I'm joined by Brian Allen, Senior Vice President, Chief Investment Officer, CS McKee. Brian, thanks so much for joining the show.
Thank you.
So I was taking a look at your notes. It doesn't seem like you're going to shed any positive light on this market right now, seeing as you don't even think it's reached the lows yet.
No, I don't think so. Obviously, playing off of Kevin's comments recently, or just a minute ago, yes, there's some good data built up we can rely on if we get positive news, any developments that are positive on the trade front. I think the 90 days was a breath of relief, if anything, sparked a short covering rally yesterday, but it also promises at least 3 more months of headlines that may go one direction or another. Some indecision. The biggest concern is that by drawing out the process, corporations are going to hold at bay any capital expenditure plans that might be on the margin. International producers, shippers may be on pause about making commitments to building capacity in the U.S. 3 months is a necessary step. The market was very oversold, very ready for anything that was a bit of relief, but we're still sort of lost in limbo until we get some better information. Frankly, we thought, and maybe a little too optimistically, we'd have much more clear progress by the end of June, which I think we still will, but has everything been put to bed at that point? Doubtful.
Okay, so I understand why that would mean more volatility in the months ahead, based on the fact that 90 days is just a pause. So I guess in one sense we might be kind of kicking the can down the road. But why haven't we reached the lows? Because I'm looking at an S&P 500 that's still down about 10% year to date. So why does it have to go lower? And what do you need to see to know that maybe a bottom has been reached?
Well, just from historic comparisons, looking at the PE ratio, say earnings on the S&P, for example, are 235 in that range. Not out of the realm of possibility that we see flat or even marginal down moves in 2025's total number. So if you're expecting say 225, let's make it a 5% sell-off or a 5% reduction in earnings, and historically speaking, you put a 17 multiple on that, you're still down around 4,000 on the S&P. Anything greater in terms of earnings downturn and a little bit tighter contraction on the multiple puts us in the mid 3,500 range. That's, I think, a bit extreme. Frankly, we see more value starting in the mid 4,000 range, about 4,600. Would be surprised if the situation really pushes the S&P below 4,000. I think despite the fact that we're playing hardball with these major trading partners, we have to be cognizant of the fact we don't want to do too much damage to the economy. And for better or for worse, and I think the long term it's worse, and it both supports the idea for bringing more productive capacity to the U.S. I think in a selective sense, certain industries that are important, where there's really value add and may have some security concerns. Some of the more basic productions, we can't give up the idea that international is probably the best price adjusted source for some of that. But going forward, we don't want to damage consumer psyche and the market so much so that we push ourselves into a deeper recession. I say, unfortunately, the top 10% of earners now, 50% of consumer spending. And whereas inflation wasn't really a problem for them in 2022, 23, the stock market takes a hit and money market rates drop, you'll see that segment of the economy will slow down purchases as well.
Okay, so if there's a greater than 50% chance of a recession, as the graphic was just reflecting your viewpoint, does 4,600 or 4,300, somewhere in that range that you were saying, reflect? Does that actually price in the recession that you're talking about?
It is fair. I think it's a fair evaluation. There's still so much up in the air in terms of just exactly what rate will be applied, tariffs to which countries, how the implementation plays out. Is it very industry specific? So many variables I wish I had a realistic handle on, but I think just based on more technical factors and trying to assume what the various thresholds for pain that the consumer and corporate America will be willing to put up with, and but more importantly, what the government thinks is sort of the outer bounds of short-term pain that they're willing to inflict. That should be, I think, certainly in the low 4,000s. I think that'll register.
Okay, so you obviously can't time the market, but what do you do between now and then? Are you putting any money to work right now as it relates to stocks, or are you buying bonds? We're seeing a sell-off in bonds once again right now.
Actually, yesterday we've been short stocks about 6% versus your typical 60-40 mix. Thought that we had certainly seen sufficiently oversold readings on the market yesterday, and the fact that it was April 9th and we basically thought something's coming. It'll be an announcement of some progress. Didn't think we're going to have specific deals that were going to be outlined, so at the very least, and also in keeping with previous comments from the president, there's the shock and awe approach that happens to begin with, and then there's the delay, give us time to work on the details. And certainly given the magnitude of the April 2nd proposal and the number of countries involved, there had to be some delay. April 9th wasn't going to be the final, not even, I don't think even any one particular country has ironed out the details, to my knowledge.
Yeah, so what'd you buy?
For the most part, a little bit in the information technology space. Those names seem to be depressed the most, but the allocation in general was really across the board, just a more top-down view than specific sectors. We continue to be about neutral weight in healthcare. That's done well, but the same in utilities. But communication services is one of our favorites at this point in time, and still slightly underweight technology. It's don't think we've seen the bottom there yet. Now, I will say the behavior in technology is beginning a little bit better with the recent lows. We tested below 5,000 on the S&P, rallied a bit, tested it again. Some of the information, the infotech companies we like, are holding up at higher levels, so there seems to be a little sentiment change there. So.
And what's on your list to buy once you see maybe some more of those red arrows that you're talking about?
Yeah, if we get a complete, let's call it, if a complete washout is in the 4,300 area or below 4,000 or 4,600, I think consumer discretionary names will be quite oversold. I know some of the airline stocks have suffered quite a bit. So those are areas where I think we'll bet on a snapback if we have a relief rally that actually marks the low, and we have some thought that this is now going to continue going forward. There's a better understanding of the tariff implications and possible plans and a runway to assume, or at least to build some estimates on earnings growth going forward, that some of those names most depressed in this sell-off, most of the marginal industries, we're not talking necessities, those will bounce back.